So that's the increase. Now we also have to pay attention to the transfers. Transfers of appreciated property by gift or on death as realization events. Today, you get what's called a step up in basis. So if I have $1 million of growth in my stock portfolio, and if I sell it today, I realize that growth, and I have to pay capital gains tax, either if they're short-term gains, remember ordinary income tax rates. If they're long-term gains, I have to pay up to that 23.8%. A strategy is, some people say, you know what, I want to pass this on to my heirs. And again, we're not just talking about investment portfolios. We're talking about farms. We're talking about businesses, talking about real estate. So and I'm not talking about your personal property. What about investment real estate? So I might want to pass this to my heirs and have that step up in basis. What step up in basis means is that all of that growth gets counted as the purchase price as of the day of death. So if I, heaven forbid, passed away today, I had $1 million in growth in my business and real estate and my stock holdings. Well, my heirs could receive that. Not talking about my wife, other than my spouse, my heirs could receive that as a stepped up basis. My wife could also, but this proposal erases that possibility. Let me explain to you what I'm talking about. Under the proposal, the donor or deceased owner of an appreciated asset would realize a capital gain at the time of transfer. That's the kind of the gist of the whole proposal here. The donor or deceased owner of an appreciated asset would realize a capital gain at the time of the transfer. So whether they donate it to a trust, transfer it to a trust, or transfer it to their heirs, there's some exclusions in here. It's a capital event, right? It's like selling the property, and tax has to be paid at that point, which is completely different than how it is today. The amount of the gain realized would be the excess of the asset's fair market value on the date of the gift or the decedent's date of death over the decedent's basis in net assets, or whatever they bought it for. That gain would be taxable income to the donor or to the decedent's estate on the federal gift tax, or the federal gift or estate tax return, or on a separate capital gains return. The use of capital losses and carry forwards from transfers at death would be allowed against capital gains up to $3,000 of ordinary income on the decedent's final income tax return. And the tax imposed on gains deemed realized at death would be deductible on the estate tax return of the decedent's estate, if any. Gain on unrealized appreciation also would be recognized by a trust, partnership, or other non-corporate entity that is the owner of the property if that property has not been subject to the recognition event within the prior 90 years. For this purpose, a tacking rule would apply to the property received in a non-recognition event from another such. So that's getting a little bit into the weeds. Let's talk about definition here. So I'm reading the definition here. Transfer will be defined under the gift or estate tax provisions and would be valued at the value used for gift or estate tax purposes. However, for purposes of the imposition of this capital gains tax, the following would apply. First, a transferred partial interest generally would be valued as its proportional share of the fair market value of the entire property, provided that this rule would not apply to an interest in a trade or business to the extent that its assets are actively used in the conduct of that trade or business. Second, transfer of properties into and distributions in kind from a trust other than a grantor trust that is deemed to be wholly owned or revocable by the donor would be recognition events. So that means that transfers to trust could also be a capital event, right? So it's just like you transfer your money into a trust. Now you've got to pay tax on that transfer. Hopefully the trust, I didn't see it in here, but hopefully the trust wouldn't have to pay tax on it because they get taxed even higher. So certain exclusions here. Certain exclusions would apply transfers to a U.S. spouse or charity, right? So that's good. Your spouse still maintains the ability to take that step up in basis, at least for the portion. Like if you have a joint account, and God forbid I pass away, my wife receives a step up in basis for the part that's my portion of that account. So that's good that maintains. So transfers to a U.S. spouse or to charity would carry over to the basis of the donor or decedent, basis of the donor or decedent. Capital gains would not be realized until the surviving spouse disposes of the assets or dies. And appreciated property transferred to charity would be exempt from capital gains tax. All right, so I actually read that wrong the first time. So transfers to a U.S. spouse or to charity would carry over the basis of the donor or decedent. So while it wouldn't be a capital event, the basis would continue, kind of like a gift. The proposal would exclude from recognition any gain. I'm down here, more exclusions. The proposal would exclude from recognition any gain on all tangible personal property, such as household furnishings and personal effects. The $250,000 per person exclusion under current federal law for capital gain of personal residences would apply to all residences and would be portable to the decedent surviving spouse, making the exclusion effectively $500,000 per couple. Finally, the exclusion under current law for capital gains on certain small business stocks would also apply. All right, so that's a lot. We've talked about a lot about that. I'm just going to stop here. Again, I've gotten into the there's a whole thing about deferral election here. It gets a little. You can see it here, deferral election. It gets a little in the weeds. Pay attention to these. Here are your takeaways. This proposal takes us from 23.8% to 44.6%, given your certain levels of income. Now, I know the levels of income stated in here are high, $1 million a year, but that could easily be realized if you're selling a business, if you have a significant bonus in a given year. And we've seen that. We've definitely seen that with clients. Selling a business, a property. So if you have significant investment properties, or if you have a farm, or some other greatly appreciated asset, that all gets tied in that calculation. It's not just somebody, it's not just the hedge fund manager who's making $1 million a year. It can be selling the family business, selling the family farm, selling even the family house. If you're above these exclusions we just talked about, the $500,000 or $250,000, or passing on this property at death could also be realized as a capital event. So these are significant changes. Do I think that these changes are going to go through? No, I don't. It gets clearer and clearer every week that this is just really discussion items, right? But again, I want you to see that this is the direction we're heading. Potential limitations on wealth conversions, much higher capital gains rates. If it's somewhere in between 23.8 to 44.6, well, obviously, folks, that's higher. So if it's somewhere near $1 million, maybe it's that $400,000 for single filers, $450,000 for married taxpayers. Folks, that's going to hit a lot of people. And the number one target is likely to be capital gains rates first, then marginal tax rates. IRMA, all those other things around it, of course, are going to generate more revenue. This is something that has to happen because we need, as a nation, more revenue. We may not like it. I don't like it as a planner, for sure, but the gap has to be filled. So it's going to take things like this. Unfortunately, we can't just increase tax rates on corporate tax. There's an increase on tax rates on corporate tax also in this proposal, but the amount of revenue produced by even doubling corporate tax rates wouldn't move the needle. So I don't say this to scare you or to concern you. I say this to make you aware. These are the things that we have to be paying attention to. This is what the discussion that's coming out of Washington. This is the reality of what we're looking at. I think that we're going to see more proposals like this from both sides of the aisle, folks, coming down throughout the years till we get to that crisis point, probably around 2030 or so, where we have to do something. I don't think that Washington is going to be insightful enough to make these changes well ahead, because they're all concerned about their reelection. It was actually, not to be political, but I was actually quite surprised to see this aggressive proposal come out in an election year. But maybe that just tells us the importance of it all. So I hope that was helpful. If you have any questions, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. And there is no webinar next week. And then we switch to Wednesdays. We'll see you on June 5th. Have a great week. I hope that was helpful, and we'll see you soon. Take care.